Hi, Jennifer Warren here, and I just wanted to discuss some of my takeaways after a Fed energy conference I attended in Oklahoma City, and also on the heels of my work with DCEO's Energy Awards and Edition here in November. And the cover story was the Pipeliner's Dream, and it was a story about Kelsey Warren and energy transfer and sort of the US's energy infrastructure development that happened as a result of basically connecting a lot of the shale basins, and how that encouraged midstream firms to rework our energy infrastructure. But the Fed Oklahoma Energy Conference was sort of an update to the conference a year ago. And obviously now, when energy is being covered, it's oil, gas, and renewables, and what the transition is looking like. And now that we've had like a year with the inflation, the IRA legislation, which is basically a decarbonization, green policy play, there's more analysis now on what's happening. And so I'm just going to cover a few things. I would say one of my thematics that I took away just from my work is that I really see an increasing hybrid world in energy. It's fossil fuels alongside cleaner forms of energy, whether it's renewables or other sources. That's one. The other thing I took away from the conference was I saw the opportunity for more circular economy type plays, both in oil and gas and in the renewables space, having to do with critical minerals recycling and all that. And that's going to be necessary, and all that has to be built. And then the other thematic that I'll note is just the idea of liquidity. And our capital markets in the United States offer superlative liquidity for the energy transition. It doesn't exist in this way, at this scale, in any other place in the world. So this is where it happens. And this is where you can see what investors are thinking. Of late, oil and gas has been more in favor, and particularly the U.S. majors. And there was some discussion a little bit about, the acquisition with Pioneer by ExxonMobil, and then also the acquisition of Hess by Chevron. And I talk about this a little bit in a podcast I just did, and I've talked about it before, but I won't go into it right now. And then the other thematic is returns. That now with interest rates being higher, returns are important. And we had like almost 2 decades of really low interest rates, and the calculus is changing now on what investments look attractive. And with energy, it's going to require a lot of investment, especially if we're going to produce and use more clean energy in the future. And something I wanted to mention too is that in this conference, it was the 10th and 11th districts, and this was the conference. And the 10th and 11th districts here, I'll show you. And there's a picture on my website. They comprise $4.5 trillion of GDP. That is like one of the top 5 economies in the world. And there is a lot of it has to do with energy, agriculture, and manufacturing, those industries. And so that's really, it's a huge economy. And so it's really also interesting to study. And now I want to go into a little bit of the detail of some of the learnings. First of all, on the macro level, obviously this was, a conference where the Fed convened this conference, and just one of the takeaways, and there were 2 Fed presidents there, the one from the Kansas City Fed, and then the Dallas Fed, Lori Logan. Monetary policy, as we know, is on the restrictive side. Interest rates are where they are, and I know that there's been new news about today even about soft landing, and I was thinking that this morning as well, that this is what they're gunning for, right? But money will cost, and this is, I think, the important takeaway right now is that where interest rates are, I wouldn't expect them to be coming down per se anytime soon, unless we really hit a recession speed bump, because the value of money has to be where it's at because of all the misallocation of capital that has been going on for a long time. And that means also that it affects investment choices. And obviously I see this play out in energy. On oil markets, demand and supply are kind of in lockstep in a way. There had been tight supply with OPEC reducing supply in the last year or so. And then we had the shock with Russia, which is still playing out. And I don't even think we've seen all how that's really impacting the global economy. I talked about it a little bit in a video that had to do with the war impacts of the Russia-Ukraine situation. And now we have the situation in the Middle East with Israel and Hamas. And the markets haven't been as volatile as what happened with Russia, but it's a factor, and we'll see how that plays out. I think the incentives are such that there is not a lot of desire for this war to expand regionally, and so hopefully that gets dealt with. And then the other thing I will say is, and this is something I've been talking about for a while too, actually since 2021, and it started with Scott Sheffield in my article for Deep in 2021, and he was the award winner at that time. The idea of capital discipline, that in the shale patch, that the large independents were no longer going to be overproducing, and they were going to adhere to capital discipline principles and return dividends back to shareholders and not just gun it on production. And so what that does, and this is something that did come up in the conference, is that the boom bust cycles of the past are smoothed. And now when you get boom bust, it really has to do with economics and geopolitical shocks. But the other thing to note is that about a third of the market structure of oil markets, 1/3 is owned of the oil market is owned by super majors, independents, private capital, and then the rest is owned by national oil companies like Aramco and UAE and Qatar and even some Russian firms. But what that means is there's a type of liquidity that exists in the market. And the fact that now the United States is 13% of global oil supply, that is helpful as well. We need liquidity, the ability to trade. It keeps the markets more transparent, even though we have Russia doing what it's been doing in oil markets, with all the gray trade. So on the geopolitical front, in oil and gas dynamics, one is that OPEC is increasingly looking at Asia because that's where a lot of the demand growth is for oil and gas. Russia reshuffled the deck, and that the rest of the world on this energy transition, they're going to do what they have to do to build their economies. Our economies, our cities were largely built off the backs of fossil fuels. And now we're trying to change that because we know that there are externalities associated with that to do with greenhouse gas emissions, pollution, all that. And so we have that in the mix now. And that gets back to my idea about hybrid world, that fossil fuels and clean energy sources are going to have to complement each other. And because we have this large fossil fuel infrastructure, a la midstream firms like Energy Transfer, EPD, and those are legacy systems that are around for decades and decades, and they require enormous amounts of capital investment. Same goes for renewables. And the challenge with renewables is that a lot of times where these sources are far away from demand centers, which gets to transmission requirements, which is expensive. And so that's a whole nother, adding another layer of infrastructure. But we're building it out slowly over time, but it's going to take time, and it's not going to happen as fast as people think, nor as fast as what policymakers would like. Because also private capital has to join. The public sector cannot do it alone. And you even see this obstruction in the trying to move supply chains to the United States, particularly the mining issues to do with lithium and critical minerals. That's just going to take a really long time, and we're probably going to end up importing from friendly nations. And China is way ahead on processing all that. Somebody said something like they're like 25 years ahead of the United States. So, if you just do the math, you can see that it's going to take a while. And at that point, there could be other breakthroughs that happen that are even cleaner and better. So there's a lot of dynamics to do, and unpredictability. And something else that came through in the conference about energy transition ideas is that in a increasing renewable world, a lot of the economics are difficult. First of all, renewables like solar and wind have to be overbuilt in order for them to provide even the capacity that is needed by a utility. For example, one example was given that if a utility needs 100 megawatts of solar power or renewable power, they have to build like 130 to make the maths work on the physics of it all. And it's also really expensive. There was a case study that was shown in New York, and they have a policy driving towards 100% clean, that right now electricity is like 20 cents a kilowatt or something. Well, that's going to double, just increasing more clean power up to 2030. And if you had 100% renewables, it would be like 95 cents a kilowatt hour. The other number that was thrown out was that, and this was by Moody's, that to move towards the goals that we have in mind, to make renewables reliable, it's like $500 billion worth of cost to make that happen. That is inflationary. So, as I had talked about at the beginning of the year in some videos, the energy transition is inflationary. It's additional. And then you have more expensive capital to go on top of it. Not that it's not happening. It's just going to happen slower and differently than what is sort of thrown out in the media, or what is said by policymakers. I'm not going to get into physics and geology a lot, but it's a big factor, and I've talked about it in the past. Let's see. On the economics side, I did cover about the costs. And then another thing that sort of came out in the conference was the idea of materials and infrastructure. Those are also headwinds with the energy transition, and we see that in terms of critical minerals and the supply chains connected to all that. And there was a lot of deep discussion, and Lithium America's CEO was there. Several renewable banks were there. So we really got the deep information about what this looks like. And then what I will show you in just a minute, I'll talk quickly about capital allocation, then I'll show a few slides. So on the bank side, because there was somebody from, I think it was Citibank, banks and obviously tech, and I'm just throwing in tech myself, like ESG, and sort of embrace it and drive their operations and all sorts of things towards that goal. Oil and gas has had to coordinate more with ESG, but they adhere to it and increasingly it is driving, how they're branding themselves and how they're diversifying their asset bases and all that. But at the same time, there's been this big recognition after the Russia-Ukraine situation happened that, fossil fuels have higher IRRs than a lot of the renewable projects. And that's sort of coming to light increasingly. And then just from my point of view, I've said this before, and I've said this for a long time, is that the idea that net zero cannot be the only metric we follow. It will result in misallocation. And there was one speaker who also discussed this, and he really kind of railed against the Glasgow Net Zero Alliance. And I've been watching them too for a while, and it does thwart and sort of it's not the true picture of how capital needs to be allocated over time to an energy transition. It's not it doesn't reflect the physics of the world, or the economics of the world, and the desire to not tank one's economy to go to net zero. And we've seen pullbacks in the UK, we've seen pullbacks in Germany and some other European countries, because not that they're not trying to become cleaner, and not that there's not projects, and not that the government's not subsidizing a lot of green projects, because they are. It's still happening, but it's going to take a lot of capital, and you can't do it only on the backs of government policy and government and taxpayer money. The private sector has to be involved. Therefore, you have to have the return profile to make the private sector want to be involved. So that's something just that I've been working on for a long time as well. So as far as opportunity goes, I would say that, I'm selective myself on my green investments. I have them, but I sort of mirror the time scales of how things are flowing. So now I'm going to show you a few slides that are representative of what I have said. These are a few from the conference that I think are quite indicative of what's going on. So this is the global oil market, and it shows the change in demand and supply. And as you can see, China has been absorbing a lot. It's a lot of where the demand in, as is other Asia. There's some Middle East. We've added since 2000, 20 million barrels a day of oil supply. We're at roughly 100 million barrels a day now. Now, where the supply is coming from, the new supply that's come online. If you look at this blue, that's the United States. That's all shale. And then also there's some supply coming from Russia over the last 20 plus years, and Brazil. And, we've seen a lot of the majors interested in that area, in that part of the world. And then you have this extra supply from OPEC players. And so that's where it's coming from. And also Canada. So that's sort of some of the supply demand drivers. And then this is just kind of getting at what the policies are about, the pledges, net zero, and just, what's doable. And right over here on the left is our stated policies. And so that's kind of what's happening and what's in place and what is being projected. Announced pledges are all the new, scenarios that would get us to like 1.5 or whatever. It's got a bigger emissions reduction path. We're pretty much on stated policies, and as you can see, oil is in the black, coal in the gray, natural gas red, solar in green, wind blue, nuclear purple, and then other renewables. Interesting, the other renewables. But as you can see, there's not a huge amount of shift in fossil fuel use. And it's supposed to go down over time, but that's not necessarily happening in reality either. So these are the ambitions to 2050. Now, net zero, it's a whole different world, and there's a lot of renewables added, and that, for the reasons I have stated, that is difficult. And so there's going to have to be some rethinking about how you integrate renewables. And sure, there's going to be breakthroughs in all sorts of renewables as well. And energy efficiency is a huge area of opportunity, both in hydrocarbon production and in renewables and integrating clean power sources. So that's really interesting. And that's a lot of tech, tech opportunities. This is just getting at some of the minerals, supply chains and minerals issues. This was actually from Ford. And they were just kind of looking at how supply chain issues are working through their firm. And basically, they were saying, critical mineral dependence is here to stay. If you're going to increase the EV fleet in advanced economies, that's what's happening. Lithium is in high demand, nickel, high demand, cobalt, same. And this is just, what is used, and just the dominant theme is that China's way ahead of everybody. And that also, they were just saying that lithium ion will remain dominant for EVs. Grid storage could evolve differently. And then this is just getting at what I was talking about. It was some of the inefficiency of renewable energy generation. This line shows you how power generation is used, and it all peaks at the end of the day. And people, a lot of people know that. And if you look down here at the bottom, solar gets produced during the day and then tapers off when you need it. Wind is more steady. This red line is natural gas. Natural gas follows the curve. It meets the demand at the right time. And then over here on the right is just all of the renewables that are supposed to be coming online. And as you can see here in 2024, there is a huge queue for projects to come online. And that means they have to get on the grid. If they can't get on the grid, then they're not going to be producing power. So you're going to be building all these solar farms, and storage, and may or may not be used. Now, battery storage is a whole nother can of worms. I'm not going to go into the details of it, but the bottom line of everything I heard was that battery storage, they say battery storage eats its tail economically, meaning it becomes uneconomic over time. And so this is some of the projections. Industry growth will come from renewable energy, in spite of everything that I've just said. It's still growing. I'm not saying it doesn't grow. I'm just saying there's a lot of headwinds and things that have to be worked out. And so this is just kind of showing installed capacity increases of 35%, wind and solar to double. But with this comes increased price volatility. And then those reliability costs that I mentioned, the $500 billion to 2030 globally to add renewables because of the effect they have on the grid. And then you have to add in a lot of natural gas and other baseload to smooth out their intermittency. And also just that renewable energy, using more renewable energy, we're also going to create excess supply. And that is capital inefficient. And that's something that you're seeing reflected in some of these oil majors' choices. The other thing that is happening, and I've talked about this in my story called Texas $1 Million Miles, and I didn't go into deep depth about it, but what happens with solar energy, because of when it's produced, all these lines represent what's called curtailment. So what happens is that solar energy is produced in excess and it cannot be used. Therefore, it's curtailed, it's held off the grid, and it increases costs in a lot of different ways. And I won't go into that, but that is a big challenge right now with solar. And that's been happening in Texas. And that is why the Texas legislature just passed, they're spending many, many billions to increase natural gas dispatchable resources to deal with the solar increases, partly, and also just Texas is a growing economy and you need steady, reliable baseload. Now, this was a slide, this was from CoBank, and they do a lot of rural investing. And I believe they're connected to the government in some way, and I can't remember. But anyway, this was a capital allocation slide, and he was just kind of explaining, how they are thinking through things. And something that I came to the conclusion of as well is that transmission infrastructure, it's really expensive. It's really hard to do. It takes a lot of years to do it. I mean, there can be projects that it takes 15, 20 years to do it. Texas did it with their CREZ lines, and there's not another CREZ lines initiative on the books. And that was to hook up a lot of the renewables from West Texas and the Panhandle. As I've mentioned before, transmission is roughly $1 million a mile. It can be $2 million a mile, and that's something that the ratepayer has to be willing to eat. The other way to get clean nuclear, well, there's a lot of dislike for that. That's going to probably also have to change some. China and India are building more nuclear. Renewable wind and solar, the climate change way, price volatility, oversupply, reliability costs. Battery storage, seemingly the easy way, not economic, and it's not a generating asset. There will be battery storage built regardless. And then this just gets at some of the capital allocation issues I was discussing. So here, all of the gray are projects that to do with hydrocarbons. And as you can see, these are here on the left, it's IRRs. So the Delaware Basin, which is right here, that's in the Permian, high returns. Midland, high returns. I think it's like 94% for Delaware, 89% in Midland, Eagle Ford, slightly less, Scoop-Stack, slightly less, Montney in Canada, more. And I've actually heard some talk about the Montney shale development. The Bakken here, Denver Jules, Marcellus is this. Now, all the green, the solar, this is all renewable power in the green. Those IRRs are like 30% down to 10% based on the grid that they're on. This orange is EV charging. EV charging can actually have negative returns in some instances. They can also have better returns in some instances, but they're largely subsidized at present. I think that is it. I will stop sharing. So you can listen to the podcast that I have on my site, and it's probably I'll probably have a link to it in a Seeking Alpha article where I will put up a few of these slides and kind of run through a little bit of what I've just said in writing, some quick thoughts. But that's some of my key takeaways from the Fed conference. And it's really just a layering on of some new information from last year's conference. Really, nothing has changed that much, except that we've spent a lot of time thinking about it and thinking things pretty and thinking how we want things to be. And we have to keep thinking that way, and it'll happen, but it's going to take a lot of creative thinking, entrepreneurs willing to risk capital, and a lot of innovation, and that's human capital. So the physics have to marry the economics. Thanks for your time.